Hi guys, in today's video we are going to talk about money management and why it's so crucial to learn more about it in your early stage in your trading journey. From my own experience, I can tell you that one of the most crucial things that you have to learn in your early stage of your trading journey is how to manage your money and your account. And most of the traders don't want to study about this topic. And probably most of the traders are not looking into this topic just because they are looking for some kind of a holy grail that can always give them a winning trade or something. And this is not the case at all. You're always going to have losing trades. You're going to have even a losing strikes. So you have to deal with it and you have to be okay with it. There is no such a thing as a holy grail and always winning strategy. Eventually, you're going to come up with some losing trade or losing strike, and you're going to have to deal with it, and you have to manage your money properly. In this video, I'm going to present to you one of the most popular money management strategies and who is actually using them and how they are using them and how they make millions with them. But before the money management strategies, I want to talk about the risk reward ratio and how important it is to your strategy, and is it so important to be, and also to see if it should be really large so that you can cover a lot of your losses, or it should be something more balanced and based on your strategy. So what I can share here is that the risk reward ratio by itself, it means nothing. Like you can have 1 to 5 or 1 to 10 risk reward ratio and you can still lose money. And what you have to know here is that your risk reward ratio should be compared with your winning strike when you backtested your strategy. And I can give you an example. Let's say you have a risk reward ratio 1 to 2, and for every trade you win, you make $2. But your winning rate is 20%. So out of 10 trades, you have 8 losing trades and 2 winners. So let's do the math here. Total loss is equal to $1 times 8, which means that you've lost $8. But the total gain is $2 with 2 trades, which means $4 in profit. So your net loss is $4. Yet, even though you had 1 to 2 risk reward ratio, you still have a losing strategy. So this is why it's so important to have comparison with your winning strike and with your risk to reward ratio. Because one without the other is meaningless. And one more thing that I want to share with you before sharing the common money management strategies is the risk percentage, and actually how much you're allowed to risk per trade. There is no universal formula, and there is actually no one who can tell you how much you can risk per trade. So this is why I'm presenting to you this table, which compares how much you have to gain if you lose a specific percent of your account. So you can see that if you lose 5%, you have to gain 5.3% to break even. So you can see that the larger the loss, the larger the gain should be after that so that you can break even. And you can see that if you lose 95% of your account, you have to do 1900% gain so that you can be break even. And this is an insane amount, and you have to be cautious about how much you lose and how much you are risking per trade. Of course, I can tell you my experience, and this is that I'm not risking more than 5% of my account per trade so that I can sleep well and I can have another chance to have a winning trade and to break even. Probably this is why Warren Buffett has this famous quote, never lose money. And you can see that by this table here. Okay, we're at the point where we can start looking to the different approaches to the money management and who is actually using them and why they're using them and what are their pros and cons. The first one is the Criterion, and a lot of the gamblers and the investors are using it just because it gives them some kind of a ratio which they can use and they can measure and by which they can manage their money. You can see the formula underneath and how it's calculated. So the P is percentage accuracy of the system winning, and the R is ratio of winning trade to losing trade. What I can share here is that one of the most famous traders using this approach is Larry Williams. And you know that he is famous for that he won the trading championship with over 11,000% return for 1 year. You can see in one of his interviews that he's sharing that Kelly criteria actually is something that made him famous and rich, but this was actually a lucky coincidence just because he was having a winning strike back then. The truth is that Kelly Criterion was made for gambling purposes and not for trading. And one of the purposes of the Kelly criteria was basically to use it in Blackjack. And you can read the book Men for All Markets by Edward Thorpe, where he's actually investigating more deeply and he shares his story and how actually bankrupt a lot of the casinos in Las Vegas back then. But it's not really a perfect fit for the traders just because you're going to have different type of styles and you're going to have different type of changing variables in your system, and you're going to be winning at some point, but when you're going to lose really, really big. So this is not a perfect fit for you. And I'm going to share with you other common practices that are better fit for trading. So we've already mentioned Larry Williams and why he used Kelly criteria before, but after that he saw that probably he's in a lucky strike and he has to think of another way to manage his money. So he came up with the fixed percent practice. And you can see that the formula that he's using is basically the account balance times the risk percent, and you have to divide it by the largest loss of your backtested strategy, and you're going to see the contracts or the shares to trade. So the benefits you can expect from this approach of money management is you're going to exclude the ups and downs of your portfolio. The other approach that I want to discuss with you is the Mark Minervini's approach, and he's a little bit different than the others, but I think it's really powerful and it can optimize your returns and it can minimize your drawdowns. So if you don't know who Mark Minervini is, he is one of the market wizards and he also won trading championship, and a lot of his followers did the same thing following his rules. The idea behind his money management is that you can start with a small percent of your account, and after that you can extend it by every next trade. So I can give you an example. If you have balance of $2,000 that you want to invest in the stock market, and you want to be 100% invested into the stock market, you can start with $300, and if this trade is actually a winning one, you can extend that on your next trade. So for example, if the first one is a winning trade, then the second one you can extend it to 600. And like this, you can go to 100% fully invested into the stock market. But if you have a losing trade, you're going to decrease on the next one. So let's imagine that you're invested $2,000, like 100% into the stock market, and you have a losing trade. The next one, it would be 2,000 minus $300, which is $1,700. And basically, this is really similar to counting cards in the blackjack, where when you have something above 10, it's going to be plus 1, and when you have something less than 10, you're going to subtract 1. The last money management approach that I want to share with you is that adding to a winning position. So who uses this type of money management? I'm pretty sure that you're familiar with turtle traders and how they become so famous. And one in the newly released books about them, there is their money management showed. The idea there was really similar to Mark Minervini's approach. The idea here is that they had a rule, and the rule was to not invest more than 2% per trade from their account. So how they actually added to their winning position? The idea was that their limit and their rule was to not invest more than 2% of their account. So they started something like 2.5 in their initial trade, and after a few percent in gains, they had to add a few more times. So at the end, they will have no more than 2% invested in their trade. So this type of money management is so effective just because you are not averaging losers as a lot of the other traders are sharing as money management, but you're basically adding to your winning position. And at some point, they're going to add up. So they were trading crossing of moving averages, And we know that this type of strategy has really low percentage of winning trades. And it was beneficial for them just because most of their trades were losers. And their losers were only with 0.5 of their account. And when they were having a winning position, they were adding to their trade till 2% of their portfolio. But something that I want to share with you guys at the end is that even though we shared here the most common money management strategies, in the end, you have to have a winning strategy so that you can implement these money management types. So this is it for now, guys. I hope you liked this video. If you do so, please like, comment, and subscribe, and I'll see you next time.